Hello, everyone. Welcome in. Thank you for joining us today. I'm going to go ahead and get started since we're already at 2:01. So I want to welcome you all to our latest online learning session, Forestry Taxes, Important Considerations for Private Forest Landowners when Filing Your 2024 Taxes. I'm your host, Michelle Kane. I am Director of Communications for the Forest Landowners Association. And today we will hear from Dr. Tamera Cushing from the University of Florida. Before we dive in, just a few housekeeping items. Do note that your microphone is muted. If you have any questions, we will address them at the end of the presentation, and you can use the Q&A feature or the chat function to ask your question. Also of note, the session is being recorded, and the full recording will be sent to you via email later this week. So if you have to drop off for any reason, don't worry. A little bit of background about today's speaker. Dr. Tamera Cushing is an extension specialist in the School of Forest, Fisheries, and Geomatic Sciences at the University of Florida. Her expertise lies in the financial aspects of forestry, how landowners can respond to different markets and policies, especially issues of taxation and succession planning. She's been dedicated to supporting the forest landowner community for over 18 years, producing a huge variety of publications, as well as presenting and hosting seminars, workshops, and webinars like this one. Tammy is widely recognized as one of the very few experts in forest taxation and is in much demand for her insights into taxation issues affecting forest landowners. So please join me in welcoming Tammy in the chat. I'll pass it to you.
Great. Good afternoon, everyone. So we're going to dive in. We are going to take a quick tour of some of the forestry tax things that I think are important as you go forward into filing on your 2024 tax return. I'll try to tell you where I think things might change, although I'm not sure that I can be honest about that today, that I actually know what might change. So we're going to go ahead and dive in. I get the slides to advance. A couple of quick disclaimers, just really important to do this. What we're doing today is educational in nature. And so just realize that I'm not a CPA, I'm not a lawyer. I have a forestry background and a tax background. And so I'm just trying to educate on what these provisions mean and how to utilize them to your best advantages. We're going to be pretty high level today when you have something that is this complex and trying to cover it in about an hour. I'm going to have to leave a lot of details out. And of course, tax law relies on a ton of detail. So I'm going to do my best today. Sometimes the answer is that it depends. That is a very unsatisfying answer to hear. And frankly, it's a very unsatisfying answer to give you. But I will do my best to answer any questions that come up, or ask you to go and send me that information in an email, and I'll follow up with you later. All right. So this is based on what I know today. I do know that some provisions are meant to expire at the end of the year. If there's no activity on them, it is likely there will be activity on some of those provisions that are going to expire. That may continue the provision. It may change the provision entirely. So I'm not 100% sure where we're going to be at the end of the year. And so we're going to stick with what we know today, and I'll just mention it if I know it's going to expire at the end of the year. And again, not tax advice. All right, so let's dive in. And so I've set this up really as kind of tax tips with, I think, 8 or 9 tips that I'd like to provide you today that kind of sums up some of the main provisions for us. One of the first and most important things to know is your classification as far as your activity level with regards to how you're operating your forestry activity. And so we have 4 buckets that we put activities in: business, investment, personal use, and hobby. Personal use and hobby are fairly similar, especially in the consequences of being in those 2 buckets. And business and investment are fairly similar in how we classify. And so if I drew a line between the top 2 and the bottom 2, I can really separate them based on profit motive. And so if you have a profit motive for your forest land or whatever activity you're engaged in, then likely you are a business or an investor. If you don't have a profit motive, then you are likely in the personal or hobby categories. And again, it's important to understand the differences. It's also important to understand that they can change from year to year. And I could own that forest land with my sibling, and one of us could be a business in the business, and the other one could be in it as a hobby. And it's really independent of each other. It's really looking at how they're operating as individuals. So when we look at that classification question and try to figure out what classification we would put on your activity, we have to look at the frequency of your activity on, in our case, forest land. And so that's complicated, right? Trees grow. I don't have to go out there and babysit them. I don't have to mow every week. I'm not constantly applying some kind of treatment to them like I might be doing in certain ag fields. So frequency of activity really isn't necessarily your hands on the activity on the ground. It can be that you are meeting with advisors, that you are walking the property lines, you are talking to maybe an RCS, or you're working with a consulting forester. All of those are activities that would be happening on the property, but it's also what are you doing out there? And are you doing most of the activities out there that would be required of somebody operating as, if you want to be a business, what would a business do? So you might look at some of the bigger timber operations and say, well, what are they doing out there? You're not going to be at quite the same level of activity on 100 acres as a warehouser might be, but you should still have the same types of activities going on out there. And then, of course, the intent. And how can I display intent to make a profit? A managed plan is a fantastic start, right? As a forester, I encourage management plans. One of the reasons for that is it's really a documentation of, like, what am I trying to accomplish and how am I going to accomplish it? So in that management plan, it's going to show the activities that are going to be required to get from putting the trees in the ground all the way through the harvest, right? So now I've got that documentation of my intent. Also, as a forester, would ask you, what are your objectives on the property? And when I meet with you and you tell me that I really need income generation from this property, and that's going to be one of your top priorities. And I'm going to have that in there. And that's going to help establish some intent. There is a way to have a presumption of profit motive. So as we're trying to, again, distinguish between a business and investment, personal use, and a hobby, that presumption of profit is that you made a profit in 3 of the last 5 tax years. All right, that sounds great. That's going to be really challenging for most forest landowners. Unless you have enough acreage that you are harvesting on a regular basis, profit in 3 of the past 5 tax years probably isn't going to happen, right? So I might look in the last 5 tax years, and maybe one of those years I had a good profit because I did a thinning or I did a final harvest. But chances are, unless you have enough acreage, most of those years you have some low level, probably, expenses. So you're showing a small loss every year. And then any year that you have a harvest of any kind, you have a big revenue. So it's really hard to show a profit motive using that presumption category for most forest landowners. So it means we're often dropping down into some facts and circumstances. We're again looking at documentation. What did you do out there? Well, how can I show that? Well, every time you get in the truck and you go to the property, keep a log. And in that log, write down what you did, who you met with, how long you were out there. All of this is to help kind of establish that you're doing everything that needs to be done out there and what's reasonable to be done out there. We can compare that to other landowners and kind of this facts and circumstances thing, right? What would be reasonable for somebody who's trying to make a profit? If I look around at my neighbors, I can look at this person over here. You can look at their property. They're not really doing anything. You can tell they're kind of not doing anything. But if I look over here I see this person is doing a lot of work on a frequent basis, and I'm maybe not quite at that level, but I'm pretty close, right? And so if I went to court and had to fight over this presumption of profit or trying to prove that I'm at a business or an investor level, what does it look like to somebody in the know? The reason we need to know this is it's a key to treatment of losses and expenses. And so your best ability to take losses and expenses is related to being in those profit motive categories of a business or investor. Business owners have the most ability to deduct expenses and losses. Investors have the next most. And then, of course, as we drop in the lower two categories, you have the least amount. There's a hobby test. You don't want to go there. But should this come up, understand this is what the IRS is looking at. This is one of the things that the IRS does like to do when they do an audit, is to check for hobby. And so it's looking at whether it was conducted in a business-like manner. Basically, if you're doing this as a business, then you should have books, you should have separate checking accounts, you should have everything that a business owner or investor would do to make sure that they were making money on what they were doing. How much expertise do you have or your advisor have? How much time and effort are you expending on the activity? Do you expect an appreciation of value? And this is something for forestry that makes a big difference, right? It's hard to show that profit year after year. I'm going to show losses. I'm going to show expenses for a long time, sometimes before I show any revenue. But I did from the beginning expect to see an appreciation in value. Where? In the trees. My trees are growing. When they grow, they put on value. Just because they're crossing into product classes, they're also putting on growth, which means there's more of it out there. So that's an appreciation in value. But the land also had an expectation of appreciation and value. And we all hope, I hope everybody understands that. How much success have you had in other activities that you've tried? You have this long string of trying things to make money and you're not good at any of it. You never make any money. Only just shows that maybe you're just trying to deduct losses all the time. And that's what they're trying to stop. Do you have a history of income and losses on this property? So can I look back and say, look, 15 years ago, I did a thinning out here and there was revenue. So it just happens to be that it's periodic based on the growth cycle and the management cycle of the property. What is the amount of the occasional profits? And that is something for forestry, right? When we have a profit, they tend to be big profits in the years when we have them, like I said, and then lots of little losses. They're also looking potentially at your financial status, right? Is this a way for you, maybe you're a doctor or a lawyer, engineer, and you're trying to offset your salary and your wages and maybe other investment gains with big losses in forestry. That's what they're trying to see is that what's happening? And then here's the one that hurts us a little bit, the elements of personal pleasure. Most forest landowners that I've ever encountered have a huge element of personal pleasure in owning forest land. They're enjoying it on their off time, but they're also working it. And so I don't want to scare you about that part, but that is one thing that the IRS is looking at, and one part where they have a hard time understanding. How can this be a business or an investment when you're out here enjoying and playing on it? It doesn't look like work. So at the end of the day, it's facts and circumstances. We're taking all these pieces and we're looking for this preponderance of evidence. What you want is the preponderance of evidence to look like you're either a business or an investor, if that's truly what your intention is. How do I break between business and investment? There's no hard or fast rules and breaking those two apart. That's the tough one. A lot of times we talk about it as profit now. A business will be more profit now oriented, meaning they need a profit more frequently, versus an investor who tends to go in and then wait for that profit, right? Again, these aren't hard and fast. These are just some of the guiding thoughts. Is there other income, or how do you use this income? Is it you're working for the money, which tends to be more of a business mindset, versus your money is working for you, which is more of an investment mindset? And again, back to the facts and circumstances. That is usually how we're prying things apart and trying to decide one thing or another. I want to say that, I mentioned that these are the kinds of things that come up, and these are the questions that they would ask if you got to an audit. And let's be clear, the audit chances are fairly low. They might be getting lower as we see some reduction in size of government going forward. But it's not a high risk of audit. There are certain things that you do that might throw up a little bit of a red flag that could increase your audit chances. But I don't want you to be afraid that you're likely to have an audit just because you have forest land. Breaking that business apart just a little bit more, there's passive income and there's active income within that business category. And the important thing is that if you're a business, you want to be an active business, meaning that you're doing the bulk of the work. There's a long list of tests related to material participation that help decide whether you're passive or not. I'd encourage you to look those up if you have any questions about that. But generally, it's, are you putting in more time than anybody else? There's a 100-hour rule. You want to be above 100 hours for the year. And you can count your spouse's time in there. So look those rules up if you have any questions about them. But at the end of the day, what happens is, with regards to income, if you are deemed to be passive, in that you're not doing materially participating in the business, then that income is going to be subject to the net investment income tax. It's an additional 3.8 tax on capital gains. If you're active, then you're not subject to that additional tax. So you can see this kind of matters. When we look at the losses, the net losses, if you're considered to be passive as a business, your net losses are going to be carried forward, and then you would offset them in future years with passive income. If you're active, those losses can be fully deducted in the year that they're incurred. So if I'm kind of thinking what's the best category, I would want to kind of be that active business, and then an investor is fine. Passive is pretty close to being the investor. And then those bottom two are the personal and hobby. Tip 2, now that we kind of understand the classification that we're in, we need to think about how we classify our sale proceeds. And so if you have a timber sale, some of the questions that get asked are, how did you sell your timber, right? Did you sell it on the stump, or did you sell the logs? Did you cut your own timber? Because we do have some folks who have the equipment. They enjoy doing it. They cut their own timber. That usually means they then turn around and sell the logs. Or did you just sell firewood? And so how you sell it can matter, but it's usually a function of which form it's going to go on, depending on that classification from the previous tip I gave you. Did you meet the holding period? In order to get preferential treatment on timber sale income, you have to hold the timber at least a year. Most folks meet that without any problems. The only time this is an issue is when you buy a property, the timber is mature, you could cut it at any point. And you either don't know that you need to hold it a year to get capital gains treatment, or you get such a good spot market, right? The prices go up and you're reacting to those prices. I'm not going to tell you, as an economist, I'm not going to tell you shouldn't react to those timber prices. If the prices sound really great and you're being told by a forester you should cut now, pencil it out on paper. Understand that you'll pay ordinary income tax rates on that. But if the price differential is that great, it may be worth it to go ahead and pay the ordinary income tax rate. You just have to kind of check the numbers out, do a rough back of the envelope calculation to kind of understand what that's going to look like. Why this matters on how we classify the sale proceeds is it's going to put you in either a capital or an ordinary income tax bracket. And in some cases, it could put you in both, and that's where things get a little bit more complicated. The reason we care, obviously, is capital gains rates are better than ordinary income tax rates at the top rate brackets. The highest rate you're going to see for capital gains is 20% right now. In the ordinary, it's up above 39%. That's a big difference. And so thinking about the times I've heard that landowners have either filed their own tax return and misclassified as ordinary income, or they've gone to a tax preparer who doesn't realize the provisions allow them to categorize it as capital gains. Either way, they've been put in the wrong bucket. It's been taxed at the ordinary income tax rates significantly higher. If that happened to you, you've got 3 years to amend the tax return, go back and fix it. Should be worth it. The other reason this matters is we think about the self-employment tax. Self-employment taxes are imposed on ordinary income. That's another 15.4% tax, in addition to the fact that you've already paid that higher ordinary income tax rate. So think about that for a minute. You're paying an additional tax and you've already paid too high of an income tax. So to me, it's a pretty large mistake to make. I hesitate to say it's the biggest mistake, but it is going to have a really big impact on the amount of taxes that you're paying. So just to quickly kind of run through what it means as far as treatment of income. If you sell timber on the stump, right? So I do a stumpage sale, then it'll qualify for capital gains. As a business, you're going to have to run it through Section 631B sale. And this is just kind of some form number information for you. If you are a personal use activity, it's an investment for you, or you hold it as a hobby and you sell it lump sum, meaning somebody pays you a total amount regardless of how much timber comes off the property. It's called a Section 1221 sale, and it goes on Schedule D, and that'll get you the capital gains treatment. If you do a pay as cut sale, and that is strictly just a sale where they come in and they say, I'll give you so many dollars per ton, per 1,000 board feet, whatever the unit is in your area. And they pay by the amount of timber that's harvested, right? And so no guarantee how much goes off. Ownership doesn't change until they actually cut the timber. That type of sale in a personal use investment or hobby situation is going to be a 1231 sale. That's going to run under Section 631B. And what happens is if your gains are greater than your losses when you net all your sales for the year, you would get capital gains treatment on the gains. If your losses are greater than your gains on it, then you have an ordinary loss. And so you see this as preferential tax treatment. And so this is the way you would want it to be treated. Losses are better when they're ordinary, gains are better when they're capital. If you sell logs, and this happens sometimes when we get into high quality hardwoods, right? A forester will have you contract with a logger. The logger will come in, cut the trees, and then you'll have a sale on the deck of the logs. And this is usually done because the buyer can then inspect the logs for quality and you get a better price this way. But at this point, you're selling logs. Logs are inventory as far as the IRS is concerned. And at that point, it's ordinary income. And so the way to, there's a provision within the code that allows us to kind of split treatment of this so that it doesn't all go as ordinary income at the higher rates. So you can elect Section 631A treatment. And what it does is allows us to break the gain into the gain from the sale of growing the timber, right? So that growth that you've incurred over time, we allow that to call that a capital gain. And then the sale of the inventory or the log is going to be as ordinary income. And so you can see this is as a business going to go on two different forms. The gain from selling the standing timber or growing the trees goes on 4797, and then selling the logs goes on Schedule C. If you have this as personal use property and you do sell some logs that you've cut, this is going to be ordinary income, but it's going to go as non-self-employment income. So you won't get penalized and have to pay the extra self-employment tax on that. So when you're having this timber sale, you do get to deduct your expenses that were harvest related. This is expenses associated with the sale. So if you've done a timber cruise or you pay a forester to cruise the timber so that you know how much you're selling, again, as a forester, highly recommend that. Or you pay the forester to administer the sale, you pay the forester to mark the thinning. Those are harvest related expenses. They come off the gain from the sale. you're going to subtract from the revenue all these harvest expenses on Form T. Form T is a special form set up for forestry, uses the language that should be very familiar for forestry. And then you take those numbers and they flow into other tax forms. But the Form T really kind of helps us put it in our kind of worldview. And then whatever you get off of Form T is going to either go on a different form depending on whether you're a business or an investor. All right, moving into the next topic, knowing your basis. So I'm trying to get you to think a little bit linearly here. So I know how I'm classified as an activity, and I'm going to sell my timber. And now I need to know the basis in the timber. So basis is not just special for forestry. If you have stock, you have basis in stock, any other capital assets. So basis is a measure of the accumulated costs of a purchased capital asset. So if you buy the forest land with the timber on it, or it's the assigned value of inherited, exchanged, or gifted assets, all for tax purposes. So that's just a fancy way of saying, what are you in it for? So at the time that you dispose of the asset, and I'm using that kind of crude language because that's how the IRS looks at it. How did you get rid of it, right? So the point that you get rid of it, we're going to need to know that basis. So if you have a sale, it's going to reduce the gain. Anything I can use to reduce the gain means I'm going to pay less taxes on it. Even if it's ordinary or capital, no matter what, I want to reduce the gain. If I have a theft of my timber or there's a natural disaster, knowing the basis is going to help determine the amount of loss that I'm eligible to deduct. If I have an exchange, then knowing my basis is going to affect the new property because we have that basis will carry over along with some modifications to the new property. And then if I get the property through a death or an inheritance, if I'm a new owner, how my basis is determined is a function of that date of death kind of valuation. So that's going to be my kind of reference point. So, and I'm going to argue that it's also something that's really important to know as we go into succession planning. And if you haven't gone down that path yet, I'm going to encourage you to start thinking about that. None of us are promised tomorrow, but knowing your basis will help you make decisions on whether you should gift the asset to someone or leave it in your will at the time of transfer, whether you want to move it into some other kind of structure. Knowing that basis is a good piece of information. So if I look at purchase property as an easy way to think about basis, the basis in my purchase property is the total amount I paid for it. And that's going to include the sales price, any attorney fees, commissions, sales taxes, everything that I paid for it. But the really important key in this basis conversation is it's not indexed for inflation. It is never indexed for inflation. And that's going to come into play later when we talk about casualties. No matter how you get the property, whether you buy it, get it through an inheritance, you do not index the basis for inflation. It's as of the time that you acquire it. So if I bought that property in 2015, it's what did I pay for it in 2015 that's going to determine my basis today. So you need to know the basis. I told you how to get it for purchase property. For an inherited property, it's fair market value at date of death generally. There's some other little wrinkles to that. So if you inherited property, you might want to look up a little bit more on the rules there. If you planted a stand of timber, then it's the cost of the establishment of the stand with a little bit of caveat. We'll talk about reforestation in just a minute. And then if you get it through a gift or exchange, there's various rules that are going to dictate how you get to that basis point. So again, sometimes you need to talk to a professional to kind of understand how a particular basis rule is going to apply to you. If it's a gift or an exchange, you likely had an attorney involved at some point, and they're going to be able to help you with that basis point. Again, the basis is established at the time of acquisition. if you don't know what it is for a particular asset piece, we can retroactively determine that. We'll look at that in just a second. Basis isn't static or stable over time. If you have capital expenditures, they're going to increase your basis. And then if you do a sale, it's going to reduce your basis. Regardless of how you get the property, we want to take that basis number and allocate it out to all the assets that we got at the same time. So thinking about that purchase point, if I purchase property for $100,000, what I would really want to do is separate out that purchase price among the merchantable timber that's out there, the pre-merchantable timber, the land. All of those pieces have value and should have basis allocated to them. Why do I want to do that? Well, if I get to that sales point, right, and I'm thinking about I'm going to harvest some timber on here, I'd like to have basis assigned to the timber so I can reduce the gain from the sale of the timber. If I don't allocate the basis out at any point, it's all on the land, then I don't have any way to reduce the gain on the sale of my timber. So it's really important to do this. If you haven't done this, I'm going to encourage you to do it. There are resources out there that can help you understand how to put these values on it in order to do the allocation. All right. Now we want to get to decreasing your sale proceeds because that's the name of the game to paying less taxes, legally, of course, right? So if I look at the equation, sale proceeds, take off my sale expenses, and then take off my depletion. Well, that's a new term. Depletion is just the recovery of your basis, okay? So depletion is how we're going to recover the basis for the timber, and we're going to recover it in proportion to the timber sold. If I sell all the timber in a particular basis account, then I could take all the basis against that as my depletion. But if I only cut some of the timber, then I can only take some of the basis to offset the gain in that timber. So we're going to recover it in proportion to the timber sold. It's calculated for every timber account that you have, right? So if I have hardwood stands out there, I might allocate basis to those hardwood stands and I could calculate depletion for those. I could separate out my different plantation ages, or I could leave it all in there together and have just one kind of blended basis account. And then when I go to harvest, I had that depletion unit that was blended over all of it. So the calculation is fairly easy. We're going to take that adjusted basis that's allocated to, let's say, the merchantable timber account, and then divide it by the total volume of timber that's out there at the time that you're ready to do the harvest. Okay. And so what I'm left with at that point is $1 per unit harvested. So let's look at a quick example depletion calculation. If I have $5,000 in my basis account for the stand of timber that I'm going to cut, and I have a total volume out there today of 800 tons right before I do my harvest, I'd take 5,000 divided by 800, and my depletion unit is $6.25 for every ton that I sell. So, you know, I'm going to receive $9.25 per ton is what I'm going to receive. I have no expenses associated with the sale, and then I have a depletion unit of $6.25, and so my gain would be roughly $3 for every unit of timber that I sell on that particular sale. I would reduce my basis account by the number of tons that I sell in order to come up with what's left in the depletion account. Next time I sell timber, I'm going to recalculate based on what's left in the basis account and the amount of tons that are out there. All right. So I mentioned when we were talking about basis that your basis in new stands is whatever it costs you to put stands together to establish the stand. And then I said there was a little caveat. There is a way to not have dollars sitting in a basis account for a new stand of timber. And it's by using this reforestation incentive that's been in the tax code. It's been there in different forms and over different years. But the current iteration has been in the tax code since 2004 this way. It is the outright deduction of up to $10,000 in reforestation related expenses. And that is per qualified timber property per tax year. Anything that goes over that $10,000 amount, we can amortize or write off or expense off over the next 84 months. And so what that means is at the end of the 84 months, you've completely recovered all your reforestation expenses, and you would have a big fat zero in the basis account for that particular stand of trees. Okay? You cannot take this on an amended return. You have to do it in the first tax return after you do the reforestation. With one caveat, one exception, you can, within 6 months of filing that first tax return, you can make a change, and you just write a note up on the top. There is a revenue ruling that you can cite, and you can make that change. But after that, you cannot amend if you make the error of not taking the reforestation incentive. I think it's a pretty big error, because if you don't do this, the dollars that you spent to do reforestation will sit in the basis account until you start harvesting. So let's say 15 years to do a thinning in the south. That's where you'll recover some of the basis, and then the rest of it will wait until you do a final harvest on that stand. That's a long time to wait. I'm pretty sure you could take those tax savings and do something different with them. I do want to make it really clear that your own labor expenses are not part of the reforestation. You can never consider your own labor expenses. There are recapture provisions on the amortization part. Basically, that's a fancy way of saying that if you take the amortization and you write these expenses off, and I said you're done at 84 months, and then you sell the forest land that you took the reforestation on, the IRS is going to claw back some of those tax benefits and some penalties associated with that. So if you think that you're going to wind up selling the property within 10 years of doing reforestation, then this is not a good provision to take. One of the nice things you can do is you can straddle tax years with forest operations. You can do a site prep in the fall. Excuse me, I'm getting ready to sneeze. You can do site prep in the fall. Oh, excuse me. And then do planting in the spring, and that would cross tax years, and that would allow you to take the up to $10,000 in each of the tax years. If you go over that, you can also take that amortization. Show you real quick what that looks like. This is Form T. On Form T, you can see I set an example of $15,000 worth of total expenditures. The amount to be expensed on line 4A, that's that 10,000. I could take the $10,000 that would be deducted in that tax year, and then the rest, the 5,000, is what I would elect to amortize. Then I would go over to Form 4562. I backed this up a couple years and had this example in 2023. You see, I'm going to start that amortization process halfway through that tax year. As the code requires, I'm going to take the $5,000 divided by 84 months. And then I'm going to take that amount and multiply by 7 or 6, because it's half a tax year. That came out to be $357 in that first tax year. The next tax year, it would be 700 and something. Okay. 714, I think. All right, next, we're going to deduct any expenses that we can in a tax year, right? So if you're a business activity level, you're going to deduct all ordinary necessary expenses incurred for production or collection of income. And then investors are going to deduct the expenses associated with the production of their income as well. But for investors, one of the tax provisions that went into play at the end of 2017 under the first Trump administration, we had a suspension of miscellaneous itemized deductions. That's where investors would take their expenses. And so currently, investors cannot take those expenses because it's suspended. That provision is set to sunset at the end of 2025. If the Trump administration follows through with extending all the things that they said they were going to extend, then we would still not have miscellaneous itemized deductions at the end of this year. That would continue. If, however, they decide to let that rule sunset, then we would actually regain the ability to do miscellaneous itemized deductions next year. So all I can say on that one is stay tuned and we'll see what happens. You can still deduct property taxes as an investor because that's available to everybody on Schedule A. And then, of course, hobby expenses are not deductible. Everybody can deduct property taxes, but after that, hobbies cannot deduct any expenses. What's an operating expense? Maintenance, ordinary, and necessary are the keywords. What is an industry standard operation for you to do? You need to have a profit motive to be doing this, and that's what we're looking for. So it's anything it takes to do managing or maintaining the property, you would deduct that in the year of the expense. Anything else that's not specifically called out that way usually is going to be a capital expense, something that lasts longer. If you think about doing an herbicide, you're going to have to go out and do that herbicide, at least here in the South, every year, right? If you want to do that. And so that's a maintenance or ordinary and necessary expense. What about non-income producing years? Not everybody has income every year with regards to their operation. You can elect to capitalize expenses instead of deducting them. That is what investors are doing in a lot of cases since they've lost that miscellaneous itemized. It's only for non-productive years. So if you have income from the property, you cannot elect to do that. So if you have income, you offset the income. But in years where you have no income on the property, this is your taxes, pruning, pre-commercial thinning, any of those expenses. But you have to do it for all of the expenses in that year. All right. Hot topic this year in the South, geez, and multiple areas of the country, actually, even with the wildfires out west, hurricanes in the South and up into the mid-Atlantic, right? We want to deduct any casualty losses if you're able to. And so the IRS looks at the deduction of casualty losses. It's the damage or destruction or loss of timber resulting from an identifiable event. I have to be able to say what event caused it. It's not this random drought. Drought is really hard to put a finger on in a lot of cases because we have a lot of dry years, but they don't necessarily rise to the level of an identifiable drought. But I can look at Hurricane Helene, right? We can find National Weather Service reports of that, or a tornado, usually an ice storm. We can find information on the wildfires. That's the identifiable event. It has to be a sudden, unusual, and unexpected event and death of the tree or damage to the tree. So, if you think about any of these major events, the tree snaps in half, pine tree snaps, it's dead, right? The product value is lost at that point. Versus a southern pine beetle that comes in and it's that slow death or decline and of property value. So personal use has to, if you have personal use property, it has to be in a presidentially declared disaster area in order for you to qualify to take a casualty loss. If you're an investor or a business use taxpayer, then you don't need that presidential disaster declaration. So what is the amount on a casualty loss? It is the lesser of the decrease in fair market value. So we're looking at before the event and right after the event. What is that decrease in fair market value? If you have mature timber, that's going to be a big number. But we're taking the lesser of that or your adjusted basis. And so I would say the smart thing to do is look at your adjusted basis first. If it's really low, then it's probably not even worth trying to figure out what that decrease is because it's going to be pretty significant. You have to take into account any salvage or insurance proceeds that could result in a taxable gain. So you salvage your timber, take it to the mill, you get paid for it. If it's greater than the basis, then you could result in that gain. But you can elect to postpone the gain using an involuntary conversion provision, but you just have to get replacement property within 2 years. And there's some rules around that. I'd encourage you to look into that if that's your situation. The loss, as we're calculating how much loss we had, you're looking at it on your record keeping unit. So what is the unit you keep your basis on? If you have your entire property in one basis account, all the timbers in one basis account, then you're looking at the decrease in fair market value for the entirety of the property and the adjusted basis of the entirety. I should say that as restrictive as some of this sounds, FLA is one of the organizations pushing really hard for changes to casualty laws. We keep hoping to see that we're going to get some changes to that will be much more friendly to forest landowners. Please don't forget about other income. We tend to talk predominantly about the timber income, but actually in other years, you may have income from cost share payments. Cost share payments are considered income. There's a calculation that you can work on to decide whether you can exclude all or part of that cost share income. I'd encourage you to look that up if you've got any of it. This is for like EQIP payments, CRP payments, not it's just the cost share part of the CRP payments, right? So you can do that calculation and you may or may not have to include most of that income. And so that's a wise calculation to look at. If you have pine straw that you're getting income for, or if you have a hunting lease, that is going to be considered ordinary income. Make sure you classify it that way and that you don't forget you actually had it. And then of course, carbon, I put a question mark there because carbon really depends on the structure of the contract, how long you've had it, when the payments are coming, how the payments are coming. And we just don't really even have good guidance on that right now. So we continue to try to get guidance. There's nothing really like it in other parts of the tax code or even in court cases or rulings. And as I wrap up kind of this whirlwind of things to think about this year as you start filing your tax returns, keep good records. I know this is thinking forward, but maybe this year you're going, wow, I can't find all my stuff, all my paperwork. There are multiple ways to keep track of your stuff. Make sure you keep track of it in a way that's going to make it most efficient for you to file next year. For yourself or for your tax preparer, if you go in really organized, you're going to pay less to that tax preparer than if you hand them a big mess of receipts. So keep all your receipts, all your invoices, your sale documents at least 3 years, because if you've made a mistake, you can go back and amend that tax return up to 3 years. I would say to keep the tax return and all the documents that went with the tax return at least 6 years, because they can audit you within that time period. Any capital expense, you need to keep all the receipts related to it until you get rid of the asset, plus at least the 3 years to amend the return. Some quick resources for you. Every year we've been putting out tax tips for forest landowners. The current version 2024 is out there and available for you. Pete Williams in the March-April issue for 2025, sorry, I almost said 2024, of Forest Landowner Magazine has almost a reproduction or a version of it in there for you. So if you get the magazine, that's available. If not, you can find the document on numerous websites. The Hardwood Timber Industry Audit Technique Guide. It's a little dated, but what it is what the IRS agent reads before they come out when they audit your property. It kind of helps them understand what's going on. Forest Landowner's Guide to the Federal Income Tax. Again, a very dated document at this point. It's from 2013. We are currently trying to finish up a revision of that. The guts of it are still a really good document, and I encourage you, if you need some help, to look there. And then, of course, there's some tax webinar series out there that are freely available to you. All right, Michelle, see if we have any questions.
Okay, it looks like we have a few in the chat. Let me see what we've got here. Okay. Is CSP payments via NRCS IRA program just income, or are they cost share?
So I'll admit that I haven't read up on what that particular one looks like right now. But the way to think about it is, if I look back at CRP, right? CRP paid people not to do things, right? And so that part of it was a rent or a royalty payment for the property. So that was just income, right? And so that didn't qualify for cost share. Most of the other programs are helping you to do something out there, right? So if I think about whether it's a fuel reduction project. So they're giving you money to help offset the expense of doing something that is deemed to be of conservation value on the property, or good forest management or forest health. So without knowing exactly the detail of the CSP through that particular program, I can't answer exactly. Some of them have different rules around them. And so if you send me an email on that particular program, I'd be happy to answer that clearer for you.
Thank you. Okay, another question that came in, and I'm glad you're answering these questions and not me. Are gates a management or capital expense? Can improved or new road related to a timber sale be capital gains expense?
Oh, Terry's asking the big tough ones today. Okay,
Yeah.
so gates, I would say that gates are capital, right? Because it's something that is going to last. So one of the other rules kind of is that it lasts for more than a year. So a gate is something that I would say is part of the property. It's attached. And so that's why I would call it that. I could see, though, that some tax preparers would maybe be a little bit more aggressive on that than I am, and might write that off as an expense. And so my view on it is I would capitalize it. And so just understand that there are differences, and when there's not an absolute rule already written down, and there's a difference in how people interpret it, how risk averse they are. So the new road related to timber sale, that's a great question. And it's really a function of what you're going to do with that road. So when you say a new road, we have all kinds of materials that we use for a road, right? So let's make it really extreme. If I pave that road in, and I put a road bank in, and I pave it with asphalt, that is not a sales expense. That is a capital expense. And if I could tell how long that road might last, I could depreciate it potentially, but otherwise it's an expense that gets added to the value of the land. Now, if I put that road in only to get the timber out, and maybe it's just I cleared it, I put down some rock in order to make sure that during the wet season that it's something that I can grip and not tear the land up. And then when we're done, I rake up the rock, I throw grass seed, I retire the road and make sure it's not being used, then I could justify calling it an expense of the sale. And so the way we tend to say it is, if I can retire the road and keep everybody off of it after the sale is done, then I have no problem calling that part of the sale. It's when you put something in and you're going to keep using it that we're going to have a problem with trying to deduct it.
That makes sense. Okay, one more question came in. Did I understand the difference between basis and casualty loss is a deduction?
Mostly. So yeah, so what we're going to do is, it's not the difference between it. So when we're looking at a casualty loss, it is the lower of the difference between the before and after, right? So I walk out there today, I got a beautiful stand of, let's go really extreme, saw timber size trees. I could cut them tomorrow, and then tonight a tornado comes through, snaps all the trees, and they are pulpwood at best, right? And so I can get a before and after of that, and that difference, that is a casualty loss, but I have to then look at my adjusted basis in that timber. And let's say I had those trees since they were little seedlings. And so, and I did not use the reforestation incentive. So I've got $200 an acre in those trees. I am limited to whichever number is smaller. And that smaller is almost always going to be that adjusted basis. And so that's part of the issue that FLA is working on, is that non-recognition that we've got all that time period of growing the trees. And you could have done something else with your money, but it was invested in the trees, and you took that risk on, and then you lost them. And so that's going to be the limitation, is you have to take the lower. If those trees are personal use for you, then it's limited even more, and I'll have you look that one up.
Yeah, and I'm just going to throw in there, what we've been working on is the Disaster Reforestation Act. So if you haven't heard about that or want to know more, I'll put our website in the chat. But we've been working on this for a while, hoping to get it passed, just to make sure that when you do experience a casualty loss, you can actually recover those costs. So our team has been working really hard on that for, I think, the past 8 years.
That's about right.
Okay, somewhere around there. I've not been here 8 years, but it's been somewhere around there. So, okay, one more question, and then that might be it. Okay. Would legal expense and surveying costs to secure an easement road capitalized also, or could that be expensed?
So I'm trying to figure out when I say an ease art, if this is the legal, I'm gonna make some assumptions. If you're looking for the legal expenses and the surveying costs to secure an easement to get to, let's say, your timber, right, your landlocked timber, right? So you have to cross somebody else's property and you have legal expenses and surveying costs. I would say that if that is part of a timber sale, I would say that that is part of the sale expenditures. If that is just to have an easement to get onto the property, I would, I feel like I would capitalize that, but I could see where maybe somebody else would deduct that. And, there's so much of tax law that is not black and white, and I'm trying to not be evasive on it. But there are people that do this every day as far as doing tax returns, and I'm going to say it this way, they know what they can get away with, right? They know that they've done what you said, and it didn't get audited, or they did get audited and it held up in an audit, but it's not anything that I can find in tax code that very clearly says that. It's not in any revenue rulings. Back to the carbon thing, it's one of those things where I almost need somebody to try it, not win on they have to get audited. They have to lose the audit. They then have to fight it by going to tax court in order to get a tax ruling so that I then understand how it's going to be interpreted. And that's a really long and expensive for somebody process that I'm not necessarily advocating for, but that's usually how we have the best clues on how IRS is thinking and have something that we can hang our hat on, at least from an education standpoint.
That makes sense. And as all of you know, tax code is very complicated, and we appreciate your time and your expertise and sharing that with us today. Like Tammy said, if you do have any other specific questions, her email is up here on the screen, so feel free to take that down. And we are recording this. We will send this out to you probably tomorrow. So keep an eye on your inbox, and we'll be sending this out. So I just want to thank everyone for their time today, and thank you very much, Tammy.
Thank you.